Good morning to one and all present here. This is the class for taxation law and practice. Already we have studied about some basic definitions about tax, something about assessee, person, income, and other definitions like assessment year and previous year. Every person who assess their income under Indian Income Tax Act 1961 for the relevant previous year will be taken into account. As per the provisions, we have classified the incomes under 5 headings like income under the head salary, income under the head house property, and income under the head business or profession, and income under the head capital gains. Then last one, income under the head other sources. Now I want to clarify some provisions relating to income under the head capital gains. So before that, we have to know what is capital gain. So what is capital gain? Any profit or gain or loss arising from the transfer of any capital asset. Such capital asset should be transferred in the relevant previous year from one person to another person. Also the profit should be earned from the transfer itself. So capital gain will be taxable under capital gains. Before that, we have to know what is capital asset. So what is capital asset? Any property, maybe immobile, movable, fixed or circulating, any asset held by the assessee. So what are all not to be included? Some items are not to be included under the head capital assets. Something about stock in trade. For an example, car held by an assessee, by an individual's asset, but the trader who is selling car, who is dealing with the car, is called stock in trade. So stock in trade will not be included under the head capital assets. Movable property of an assessee may be the wearing apparels except jewelry. Jewelry is a capital asset, maybe short term or long term, and furnitures are not to be included. And agricultural land which is not situated under urban areas, which is not covered under urban area. Then gold bonds issued by the national defense gold bonds or national gold bonds issued by government are not to be included. So we have to know what is capital asset and what are the different types of capital assets. One is short-term capital asset and another one is long-term capital asset. Short-term capital asset means asset held by an assessee for not more than 36 months. It means the asset should be sold within 36 months from the date of its acquisition or purchase. So it is a capital asset. Then in case of shares and securities, equity shares, preference shares or debentures or government securities which are listed in a recognized stock exchange or any units issued by mutual fund or UTI, which is held by an assessee for not more than 12 months. In case of an asset for 36 months, not more than 36 months. In case of shares and securities, not more than 12 months. It is called short-term capital assets. On the other hand, long-term capital asset means any assets which is held by an assessee for more than 36 months. It means the asset is sold during the relevant previous year, which is acquired by an assessee before 3 years. After completion of 36 months, transfer will take place. So here we have to calculate capital gain. For short-term capital assets, there is no more calculations. We can calculate from the full value of consideration. We have to consider the value of consideration. From that, we have to reduce expenses relating to transfer. It means any expenses borne by the assessee relating to sales, I mean brokerage, commission, etc. Balance amount is called net consideration. From the net consideration, we have to reduce cost of acquisition. It means cost of purchase of an asset. Then cost of improvement. Here improvement, we have to know what is the meaning for improvement. Improvement means any additions made by the assessee. For spending some amount for keeping the asset in workable condition is not an improvement. Making some additions is called improvement. So we have to reduce that cost also. Balance amount is capital gain, short term capital gain. Then another one is long term capital gain. Any gain on transfer of long term capital asset is called long term capital gain. Here we have to calculate long term capital gain from this following. We are taking full value of consideration, the sense sale price of an asset during the last year what we have sold, then less expenses on transfer, expenses relating to sale of that particular asset should be reduced from full value of consideration. Balance amount is called net consideration. From the net consideration we have to reduce indexed cost of acquisition. For short term capital assets we are reducing only cost of acquisition and cost of improvement. Here note this, we have to reduce indexed cost of acquisition and indexed cost of improvement. So what is indexed cost? Once the asset acquired, take an example, gold acquired before 10 years, before 10 year was very less, but nowadays it's going up, price is going up. So we have to calculate present market value of that particular asset. So we need some indexed cost. We are having cost inflation index under cost capital gain. So we have to calculate indexed cost of acquisition and indexed cost of improvement. For calculating indexed cost of acquisition, we have to categorize the assets based upon the purchase of an asset. We have to categorize. First one is that particular asset acquired before 1/4/2001. Before 2001. Second category, long-term capital asset acquired after 2001, 1/4/2001. Third category, long-term capital asset acquired by the previous owner before 1/4/2001 but transferred to the present seller by way of gift or inherited, maybe the inherited property or by will after 1/4/2001. So we are categorizing the asset into three types. May fall on any one category. So we can apply any one of the formula to calculate indexed cost of acquisition. For the assets acquired before 2001, 1/4/2001, the formula is actual cost or fair market value, whichever is higher. Actual cost is compared with fair market value, whichever is more will be taken into account, divided by cost inflation index for the year 2001 and 2, that is 100. Basic for the base year it is 100 into cost inflation index for the year of sale, that is 22/23, 331. For the long-term assets acquired after 1/4/2001, actual cost only considered. Actual cost divided by cost inflation index for the year of purchase into cost inflation index for the year of sale, that is 22 and 23. Then third category, long-term capital assets acquired before 1/4/2001 but transferred to the present seller by way of gift after 1/4/2001. Actual cost or fair market value will be taken into account, whichever is more will be considered, divided by cost inflation index for the year when present seller became its owner, into cost inflation index for the year of sale 22/23. So here we have to calculate indexed cost of acquisition. That indexed cost of acquisition is reduced from net consideration. Then another one is indexed cost of improvement. No indexing for the improvement which was made before 1/4/2001 because the value of improvement was included in fair market value of the assets. So for the improvement made after 1/4/2001 will be taken into account. For that we have to calculate cost of improvement divided by cost inflation index for the year of improvement into cost inflation index for the year of sales. Regarding another one provision, it's very important. While calculating indexed cost of acquisition, we have to consider whether any advance money received and forfeited by the present seller. Sometimes the seller may with some agreement, they may forfeit some amount. Sometimes the buyer cannot materialize or execute the sale proceeds. So the seller may forfeit some amount. At that time, the cost of such asset shall be reduced. from the cost of acquisition, from the actual cost or fair market value, whichever is taken into consideration, from that amount, advance money received and forfeited by the present seller is to be reduced. After that, we have to calculate indexed cost of acquisition. So we can get long-term capital gain. Once again, I tell you, full value of consideration. From full value of consideration, we have to reduce expenses on sale. It means brokerage or commission given to sales. Then from net consideration, indexed cost of acquisition and indexed cost of improvements are to be reduced. Indexed cost of acquisition means cost inflation index is to be applied. What is cost of acquisition? Actual cost of purchase. Indexed cost of acquisition means by applying cost inflation index, we have to calculate the present value of an asset. So it is called indexed cost of acquisition. For calculating indexed cost of acquisition, we have to categorize the assets into 3 types. Then indexed cost of improvement. For indexed cost of improvement, improvement was made before 2001 will not be taken into account. Made after 2001 is to be considered. After calculating long-term capital gain, we can get some exemptions. We can claim some exemptions under various provisions. Let us see some exemptions. First one is capital gains exempted under section 54. It means transfer of long-term residential house property. Capital gain occurred from transfer of long-term residential house property. Income from the residential house property, capital gain from the residential house property is to be reinvested in the same. Again the assessee investing the amount in the same. Another one, residential house property. We should keep 3 points in our mind regarding under section 54, exemption under section 54. We have to consider 3 points. What it means that the assets new house property should be acquired within 1 year from the date of its sale, 1 year before its transfer, or 2 years after its sale, or construction of new house property within 3 years from the date of its sale. So we have to acquire new house property before 1 year from the date of its sale or after 2 years from the date of its sale if the property is already constructed. If the assessee wants to construct new property, means he can claim 3 years period from the date of its sale. The amount of capital gain so invested in new house property is fully exempted from tax. The same newly acquired house property should not be transferred, cannot be transferred for another 3 years. Otherwise, the already what we have claimed exempted amount is to be considered as new long-term capital gain. Then second one, exemption under section 54F. Capital gain from any transfer of any long-term capital assets, maybe the residential house or any asset, jewelry, whatever it may be, to be reinvested in long-term specified assets. What is long-term specified assets? Long-term specified assets means bonds issued by National Highway Authority of India, Rural Electrification Corporation Limited, Power Finance Corporations. We have to invest the amount long-term capital gain within 6 months from the date of its transfer. Within 6 months from the date or sale of the existing asset. So it's fully exempted from tax. And the another one is transfer of any long-term capital asset other than residential house. Any property can be sold. From that profit, we can invest the amount in new residential house. Here we have to calculate proportionate amount to claim exemption. Formula for calculating exemption is long-term capital gain into amount invested in new residential house divided by net consideration of the existing asset what we have sold during the relevant previous year. Here we have to calculate the exempted long-term capital gain from the long-term capital gain what we have calculated. On the other hand, assessee is having some privileges. We can invest the amount in capital gain deposit account scheme for 3 years for purchase of residential house or construction of new house for some other purposes. Within 3 years, we have to complete the work, we have to invest the amount. Otherwise, the amount deposited in capital gain deposit scheme is considered as long-term capital gain, which is to be taxable as per the provisions of that particular year. Thank you.